Okay, so it seems everything's okay. That's great. So, guys, I want to obviously just kind of, we're close to the beginning of the week. Sorry, I've still got that cold that I spoke to some of you about last week, and that's why I wasn't here last week. But we've had a few kind of key things over this week, and the first one, over the course of this morning. The first one has been. We got much better data coming out of the UK, which really leaves this central bank meeting on Thursday from the Bank of England very much up in the air at this stage. We've also had some economic data out of Europe, which has caused a little bit of volatility coming out of the euro. Euro dollar was as high as kind of 130.80. It's now come off just a little bit because we've just had some retail sales data. Just bear with me one moment. We'll just find out what happened to them. Okay, they were much better than expected. Yet we've seen euro come off. Now that is kind of the wonderful world that we live in, I suppose. But let's take a quick look because there's probably a technical reason why. Let's start. Euro is as good a place as any in this environment, I think. So let's get going. So this is the hourly chart. So as you can see here, potentially getting a little bit sticky around this 130, 150 mark. This is just the hourly chart, so it's what's kind of gone on just the last couple of days. As you can see, a really nice bottom there. 129.80 is a real. Between 129.50 and 80, there's an awful lot of bidding interest. So there's an awful lot of kind of buyers lining up to buy on the dip, suggesting that maybe investors are just hedging themselves in case Draghi isn't as dovish as he was this time last month when he spoke at his meeting. I guess I'm just going to take a step back there, guys, and just say that the first key thing that's really driving markets this week is kind of central bank meetings. We had some big moves last week. We had that sub 130 in euro dollar, sub 150 at one point in cable. We do see ourselves kind of getting into a bit of a period of consolidation here. And this is what we're seeing right now in euro dollar. Remember, over the last kind of over this quarter, so since kind of the start of 2013, we've seen a lot of trending in markets. Now, over the whole of 2012, markets didn't really trend, or maybe, they trended for maybe 30% of the time, 70% of the time. They were stuck in ranges. So really, this kind of consolidation phase that we might be entering into, certainly in the short term, is perfectly normal, and it doesn't mean that you have to. It doesn't necessarily mean that the trends of yore are gone. It just suggests that the period that we're in right now is maybe just one of slightly more maybe measured moves. We always need more fundamental drivers to push markets higher, and that's kind of what we're looking at right now, trying to gauge what are those drivers. What we've seen and what this price action here tells us is that 130, obviously a very important psychological level. Anyone who's been in the markets for the last kind of 2-3 years will know that. And whenever we get we have been obviously sub 120, 130, but 130 is a massive level and has been a huge level during this sovereign debt crisis. It's where the market has really hovered. It's where the market has taken stock. It's where the market's digested. What's going on in the wider eurozone. It's a real important level, and the fact that we've kind of been hovering around this level, trying to stick to this. Handle, this 130 handle is the massive, is because it's such an important level and it's a massive deal. I think the market has really been trying to get a direction one way or the other, or a catalyst, really searching for catalysts one way or the other. The Italian election in par se doesn't seem to be enough to push us lower. And likewise, the threat of ECB easing, the weak growth, that's really keeping the upside limited really from here. So I'm just based on, you've got to trade on the technicals in this environment, and that's a clear defined range there with kind of 129.80 on the downside. Oh, let me just put that there. And probably looking at it, obviously 130.80 on the upside, and then this kind of 131.10 level, which is really important. I'm going to show you another type of chart to show you just how important this is. Not only is the 200-hour moving average. Let's go here. It is also here, as you can see, it's the top of the base of the daily exchange cloud. So let me just zoom in. I know some of you who join regularly will know itchy maker clouds, they're quite simple things to trade on. Basically, anything below the cloud is a downtrend, above the cloud an uptrend. I get these kind of lines here. You get your keyed in your Tankan, and then the grey line here as well. And they are all kind of, it's grey one is important, but it's the lagging line, which kind of just. Overall, what this kind of itchy maker suggests to us is that even though we are below the cloud right now, we're not getting a lot of cutting out of long positions, but the market is still a bit undecided. So kind of like, so this is the kind of pattern that you see around this pricing mark. We're clinging to the base of that cloud. Now we're currently below it, but we really are struggling to make headway above the cloud, back into the cloud. So 131.15. Not only is it the 200 hours, I think we need to take away from that. It's a significant level. It could be a very sticky level. And we've really started that we could see the market kind of struggle a little bit as we get closer. It'll be interesting to see how the market reacts to it. Some people have thought that maybe the euro is looking slightly oversold. Just take a look here. Probably to look at it at the older, at the long-term chart. So this is the daily chart here. As you can see again, back above that 200-day moving average. So again, there is a little unwillingness right now to push the market lower, and we think that's because of the ECB meeting that's coming up on Thursday, with the market really just waiting to see what happens. Well, just here, as you can see. This is a longer term support. This is long-term kind of uptrend support, and the fact that we're still below there really suggests that, for us to have another bullish bias, we're really far away from that right now. However, we are finding good support here. So, 130.20 is if that's acting as kind of the trampoline, if you like, where the market then bounces higher, then you've got some clearly defined resistance zones. Obviously, 131.65, this double top from last week, and then you're looking kind of 133.5, which is this other key level. So again, we're not looking for a massive pullback. Just as the market gets kind of back being a bit neutral, the CFTC data, those of you who follow this regularly will know that I do write a lot about that. That actually saw a big scaling down of. In fact, let me just show up. Of speculative positions in Europe there. We're now just in negative, neutral, which is why we're kind of clinging to these key support zones. It all kind of adds up, and it tallies really well with the fundamental side of things. So you've got this, big ECB meeting and the market looking for direction at the same time. It suggests to me that the ECB meeting is going to be the thing that sets the tone. Remember, it set the tone last month with euro-dollar kind of falling, over 700 pips. Since spoke last time. The thing I want to show you is the pound was a huge mover on Friday. That sharp move lower. This is the daily chart, as you can see. Got to kind of 2.5-year lows. Sharp move lower, below 150 at one point, but we've since recovered quite nicely. This still looks to me like it's just consolidation. What we've seen is a better than expected service sector PMI. Sorry, just bear with me one minute. What we saw was better service sector PMI for February. That helped kind of push us back towards that kind of back above that 150 level, and that's been really seen in a lot of crosses. Also here, just take a look at that potential bullish crossover in the MACD. Again, just suggests that there's this kind of better momentum, and that what we may see is, the markets had been expecting, that there had been a little bit of resting expectations that the that the Bank of England would do more QE this as early as this week. Potentially, the better than expected tone to the February service sector PMI suggests that that the market may get a reprieve. There might be no more QE, and instead we might they may just stay on hold if we don't hear anything from them, which would allow a deeper pullback, more of a recovery. So again, fitting into this consolidation phase. Now, interestingly enough, in Euro sterling, actually, this is Euro sterling daily. As you can see here, Euro sterling is really been kind of everywhere. We saw a lot of selling pressure in euro dollar, euro sterling. So euro sterling kind of moving higher in recent weeks, and that was kind of the highest. This is the most selling pressure in euro dollar that we've seen since kind of May 2010. So pre the sovereign debt crisis, which really shows people have been getting out of the pound very aggressively and moving back into the euro as kind of perceived stabilisation in the euro has taken place. The other thing that we would point out is that, obviously because of those moves, when you get a data surprise in the UK like we've seen today, obviously the actual surprise itself wasn't huge, but what it does show is that what it did do was actually reinforce the fact that the markets are. Reinforce that maybe the UK economy isn't as bad as it seemed, and it just got rid of a bit of the pessimism that was impacting euro sterling. So as you can see here, euro sterling's been one of the casualties actually of this better than expected PMI from the UK. So those of you who follow us on Twitter, Forex.com, we're also on StockTwits, but basically we did say before this PMI data to watch euro sterling. And hence, lo and behold, that was worth doing because we did have a sharp move lower. Now, we found some fairly good support around 85.50. Around just below 86, so around 85.50. We do think that there could be kind of a more prolonged decline, potentially as we lead up to this BOE meeting versus ECB meeting. And on Thursday, this cross is really going to be worth one to watch. It's definitely going to be one to watch. Sorry, getting my words mixed up. But the reason why I think is because what we're seeing is that, in my view, the reason why is because we've got the if the ECB does something dovish and the Bank of England doesn't, especially when there's so much easing already priced into the pound, we think that could really help the pound to recover, especially against the euro, and we could get back down to that kind of 85.5 mark. So that really is worth watching. But as you see, very much range bound. We know the range now, 86.50, this cluster of hourly SMAs. It looks like we're going to trade sideways. And then again, it fits this kind of theme of consolidation that we may see this week. And obviously kind of on the downside, look, nice buying interest there. The fact that we've kind of, this is just the hourly candlestick to the daily as well. As you can see, very nice support zone there. You can just see it by eye, kind of around about the 85-80 mark. So there is buying interest, but I am also just aware of kind of, let me just go to better. I'm also aware of these lows here. That to me looks a bit like a false break lower. And we're not saying that we're going to see, a massive decline back to kind of the sub 80 levels. Not at all. We just see, when you're in consolidation territory, do is you back off and you feel longs. And there could be some weak longs, especially as we move up to these central bank meetings. Because again, remember, markets are looking for direction, and for that, they really need to look at the to do that. Sorry, they really do need to look at what's going on in the central bank space. Now, talking about central banks, the RBA was the first of the major central banks today to have their meeting, conclude their meeting, and they were fairly neutral actually. And I think the key thing to take away from their statement, which I've got right in front of me, is that the fact that they seem to suggest that there's already been easing. They said during 2012 there was significant easing in monetary policy. The full impact of this will still take time to become apparent. There are signs that the easier conditions are having some of the expected effects. They did say, of course, that the exchange rate remains higher than might be expected, given the observed decline in export prices. But I think the key thing to take away from there is that they're very much still in wait-and-see mode. They've done their job. What the RBA is saying is that we've done our job. We're now waiting to see the effect of it. We're not just going to be cutting rates willy-nilly because we got weak PMI data in China, and I think some had expected that. We obviously, on the back of that very weak PMI data, just bear with me one moment, we did see a sharp decline there in Eurodollar. Look, very below that 101.50 mark, which is a key support level, going all the way back for kind of 8 months. We got below it yesterday, but whenever you see a sharp decline like that, whenever you see a very sharp that kind of hammer pattern there that you can see is a bit of a reversal. It suggests to me that what we're seeing. Someone just said that audio is messing. I don't know why that is. I do apologise. I don't think it's my side. Potentially it's your machine. I haven't had any other problems from it. So please do maybe adjust your machine a little bit. But basically this hammer pattern here, just bear with me one moment. I'm just going to pull up my other chart because I can get to see it a bit better. This hammer pattern that we see here on this chart, whenever you see kind of that lower wick, suggests that actually the bulls didn't win that fight. They tried to push the market lower, it didn't get there. Instead, we got a nice push higher today. Obviously, that was, there's whenever you see that kind of hammer pattern, it does suggest that the market is trying to put in a low, and it did kind of around that 101.20 level. Now that's a massive support level. Okay, so it seems like there was a bit of audio problems here. FX Street, if you can maybe get involved, that would be great. I do apologise, guys. It's only from the two of you that I've heard this, and it could be down to maybe shutting some other apps that you've got. Maybe your machine was just working on overdrive. But I do hope everything's okay now. So please do let me know. But basically, what we've seen is another big move higher. We've seen a big reversal higher from way back. We shot back above those 101.50 lows, and we're also now testing kind of a close to that kind of, we ran into resistance at 102.50. Again, this is part of the consolidation theme. We don't necessarily think that we're going to see, a big move higher. I just don't at the moment. For me, I know some people will look at this chart differently, and all they'll see is a downtrend. I'm looking at this trend, and that's perfectly right. I completely agree. So since the beginning of this year, nice downtrend of the Aussie dollar. However, you go back 3 months previously, and what you're seeing instead is kind of almost a mirror image. So you're seeing a range basically, and I think it is quite useful. You've obviously got kind of 102.80 is a massive support level. Resistance level. That's the 21-day moving average. That is going to be important. And then obviously, as I said, on the downside, 101.50 then 101.20. Parity obviously a very, very important level psychologically, but it does seem like an awful lot of waiting interest there. Now the market is not necessarily taking the what the Reserve Bank of Australia is saying that closely. Instead, what they're almost kind of what the market is doing is like, well, okay, fine. You want they're not really listening to it at all in this kind of world of currency wars. Just because the central bank is a bit perplexed by the strength of the currency doesn't mean it's going to push it lower. They're going to have to up their rhetoric big time if they think of that case. So in that sense, we've kind of got over a big hurt. The talking down the currency war thing in Australia at the moment is not an issue, which is one thing to watch. But, where do we go from here? Well, the market is suggesting that in the longer term, just a little bit like we're kind of in consolidation. So we've got that phase. We've got this kind of flattening of the MACD as well. So in that case, what you need to do, maybe that's not useful for you. So instead, you need to narrow down your time frames. And as you can see here, really nice recovery the last couple of days, back up to those 102.50 levels. But we are starting to look very overbought on a short-term basis, which may see a bit of a pullback down to that 102 level. And we probably wouldn't look to enter any more longs until we get a pullback from here, because it could potentially be another resistance zone. So I think kind of you've got to employ your range trading strategies, maybe shorten your time frames and be able to. This is a good market for scalpers actually, whereby you kind of selling it when it gets to the oversold levels and potentially picking it up on those dips around about that kind of 102.10 level, which is the 100-hour moving average as well. So you've got quite a good technical basis for very short-term trading there in Aussie. Obviously, kind of the move was, as we mentioned yesterday, that from that low back to 101.50, which we think will attract an awful lot of buying interest going forward. Purely because, remember, the Aussie is still an attractive currency when markets are fairly stable, because it's got better yield than other currencies. So it's a good one to buy, especially kind of against, the US dollar, the yen, etc. These very low interest rate economies, and the pound, of course. However, the pound, a lot of negativity has been priced into there already, so you might be better doing it against, the dollar, etc. Obviously, those of you I know who were trading the markets yesterday will have noticed there's not really been too much of a move in the dollar post those requested cuts. In that note, let's just take a quick look at the index. Just give me a moment. Oh. As you can see here, dollar index also cut back off those highs. That's looking like a nice double top now, 82.5, which is significant. We're currently testing around about the 82 support level. Below there, kind of 81.60 comes in, so that there could potentially be some more downside to come. The other thing as well that I want to point out, sorry. As you can see here, they didn't watch where the dollar goes, and right now we've had some very dovish Fed speakers, and that really has limited upside. Along with that, we've the fact that we're still seeing large inflows into treasuries when we get about conversion. That's always also going to keep dollar yen is obviously a key. The news at the moment that's saying 94.70 was the high from last week. We've had nice kind of reversal level, double top there, tweezer top almost, and since then we've kind of managed to stage recovery again. It's all this consolidation mode. I mean, there's very good support just above 91, and yet we seem to be running into short-term distance at 90. For us, we do have a Bank of Japan meeting next week. The announcement will be on Thursday. We don't think they're going to really tell us anything different. We think they're going to remain on hold, because remember, it's the last meeting with the old governor, or the last meeting before the new governor comes on board in May. So what we may see is the Bank of Japan becoming a non-event, and that leaves open the payrolls data on Friday as being the kind of key near-term driver for this cross. But basically, at the moment, you've got these kind of, we're supportive, even though this, to me, looks a bit like a triangle pattern for you. Whereby you've got a nice top there at 70. And you've got, we've still got a series of higher lows. So that's going to be quite important. Obviously, a couple of days we've fallen off, but the fact that we're holding support kind of above 93 is quite good. If we can stay above there, then we may push higher depending on payrolls. Obviously, a good payrolls report could easily get us through 94.70. So you do need to watch out for that. But again, dollar yen is my trade that I'm keeping on the back burner, that I'm looking to the side. Now, something that's much more interesting, I think, is like CAD. I do apologise for kind of hijacking this session. If you follow us on Twitter will know I posted something this morning looking at wrong trend line, looking at dollar CAD, because obviously we've got the Bank of Canada meeting tomorrow. We've seen a lot of data coming out of the Bank of Canada, also coming out of the also coming out of, the economic data hasn't been fantastic either, which just kind of reinforces this quite bearish theme to the CAD, and it's been like that for quite a while. Let's just take a look at the daily charts. You can see that kind of sharp move higher, breaking out of its prior range at 101. What we've seen here is a really nice support. We've seen a bit of moderation, so the CAD come back a little bit as the dollar sold off the last couple of days, but we have found a very good support. So, this is the hourly chart. This is the hourly chart. So what we've got is a really nice trend line where you've got three, it's hit it 3 times. That means that it's significant. And as long as we can kind of stay around about this kind of above this 102.50 level, then we could kind of bounce higher. Remember, we did try and test above 103, but we got rebuffed. But I think the fact that we've managed to hold this level suggests that we could actually push higher. And again, as I said, some further, I think a lot of dovishness is expected from the Bank of Canada, even though they are expected to remain on hold actually at 1%. No one expects a rate cut. Obviously a surprise rate cut, and you could really see us back to kind of 104 pretty quick. But I think that, the fact, if we do continue to see weak economic data out of the US compared with out of Canada compared with the US, that could be the thing that kind of keeps it. This is certainly one to watch, and I'm a little bit more neutral on this. Certainly on the hourly basis, it looks like we're just, the MACD's just turning up. We're holding this support level, but I am just a little bit more concerned. There is obviously, we have got employment data coming out of the US and Canada on Friday. I think that could be quite a nice little fundamental trade, really, because if they are quite, if they're both, or if, say, Canada's isn't as bad as it has been in recent weeks, likewise, if the US's is still quite weak, it's going to reinforce that QE theme in the US. Remember, the Canadians aren't doing QE, which could actually help kind of just cause a bit of volatility in this cross, maybe see it go back down towards that kind of 102 level, or even kind of 102.30 level. Still, in the long term, I don't really like the CAD. The reason why, I think on a long-term basis, I think the US is going to need less of Canada's imports, because the US is becoming much more, independent when it comes to oil. It's now become kind of a net producer. So that is, and imports have fallen quite sharply. That's important for a thing like Canada. That could erode its terms of trade and be quite negative with the Canadian dollar on the long term. That's not necessarily something for a retail trader to trade right now, but it's certainly worth keeping at the back of your mind, and it could actually help limit downside in dollar CAD going forward. Because some people will be thinking about that. Guys will be thinking in terms of kind of macro themes over the next few years, that maybe if the dollar is changing, if the US's oil dynamics are changing, then that's going to impact the Canadian dollar. But I do digress. For now, though, however, we've had a nice bounce above here from this support level at about 102.60. Good resistance was coming kind of 102.85, and then of course the 103 level. So we may just kind of trade in between that range up until the Bank of Canada meeting tomorrow. We get the announcement at 3 o'clock and a statement from Carney coming into one of his last meetings as the head of the Bank of Canada. So that is certainly worth watching out for there. We could certainly range trade into that and then wait for that Bank of Canada meeting. Obviously, if they're quite neutral, then the next thing to look at for this cross would be payrolls. So I'm kind of done. If anyone's got a question, please let me know. Happy to answer a question. Oh, thanks, Ray. Yes, I am recovering. Compared to last week, compared to Friday. There is something bad going around. Even the Queen got it. Did we cover gold, Black Hat? No, we didn't. That's a good point. Let me talk about gold. Gold's a difficult one, I think. I don't know anyone else there. Because of this chart. You know, gold is actually in this chart. Let's go even longer. You know, gold is going to find support at 1550. Let's face it, it is. It's an annual low. It's not going to move. We don't see it kind of getting significantly below there unless we get, you know, some more dovishness from these central banks. So a lot of it, so gold is a tough one, and it's going to be one of those reactionary trades. We're going to have to kind of react, we think, to what comes out of the Bank of England. More easing, and that should be gold going lower. How low? Well, let's look here. That 1550 level is a massive level, and then obviously it opens the way to 1500. The other thing, of course, if we get less dovish than expected ECB combined with better than expected payrolls, then we may get back up to these highs here, which is also the 21-day moving average, about 1615, on the way to kind of that 1650 level. There's an awful lot of resistance on the way up. It could be quite incremental, but I think it's one of those kind of binary outcomes for me, whereby you have, easing gold is still that QE trade. If we get new QE, that's gold negative. If we get new QE, that could push gold higher. But if we get kind of stronger than expected payrolls, then we could see gold go lower back to that 1500 level. So remember, gold being the ultimate QE. I think I got it mixed up the wrong way. My brain mustn't be working well. Less dovish than expected ECB maybe, combined with better than expected payrolls, and that could get us below 1550, which is a significant and a very bearish development for the yellow metal. But as you can see here, this is the chart really since September. It's just been kind of one, it's move lower, move sideways, move lower, move sideways, move lower. Looks like we're in the middle of the move sideways movement. So that's quite normal for gold to consolidate before it moves lower. But the fact that we're so close to that 1550 level suggests, and, added that there doesn't seem to be much impetus to buy gold. People seem to be more interested in buying stocks. Remember, stocks, better yield than gold, that type of thing. Suggests that gold is vulnerable in the medium term to another push lower. But again, it's, below 1550, that would be kind of the place to maybe enter a short, and that's where a lot of algos, for example, will be triggering those shorts. So anyone, if you see any kind of things like, oh, there's so much QE in the world, buy gold, it's probably a good thing to sell on better levels, maybe towards 1600. The other thing, someone's just asked for cable, for sterling Kiwi. Happy to look at that. As you can see, it's actually again consolidation mode, which is the way of sterling Kiwi. As you can see, for most of kind of the fourth quarter last year, it moved sideways, and then it kind of really took a battering as sterling came off very hard in 2013. But it's now moving sideways, and we would say as well with this cross, really look at what cable is doing and what the Kiwi is doing. We've seen the Kiwi come under pressure today. Cable start to recover. Obviously, near-term support there, 184. 184. 10ish. If we get over there, it does kind of open the way back for a move towards kind of 185 and then maybe 185 and a half. These lows from here, but I still see us being in consolidation mode. So obviously, kind of as we get closer to 183, if we can get over kind of 183.50, it may give us a chance at kind of 183. Well, sorry, 184 towards 185. But I see us kind of trading in a range with 185 being where we get sold and kind of 181.5 being a good buy area. Someone's just asked for pure Kiwi. This will be the last thing that I look at. Again, it's this daily chart. Again, we've fallen off. We've come back, pulled back a little bit today. Sorry, let me just look at this. Kind of, rebuffed that 83 level, pulled back a little bit today, but, really trading sideways. Very, very good near-term support, 82.60. That could be a very short-term buying interest, but, this area here is a real, between kind of 82 and 82.50, we think is a very big buying area in the Kiwi. But to get us kind of back above that 83 level, I think it would depend on, what comes out of Australia tomorrow with those GDP figures. Also, let's just see if there's any fundamental drivers for New Zealand. Not massively this week. Some Q4 stuff. Do we have any central banks? No central bank meeting. Obviously, I think that's coming up the next couple of weeks. So I would expect us to see when that is. Yeah, the 13th, which I believe is next week. is next Wednesday. The RBNZ meeting is. So I think we could potentially range trade in Kiwi. Again, that 82 zone being good support, with 83 at the moment being very good resistance. But if we do get above that, I hope that was useful. Please do join us next Tuesday for some more, and good luck trading this week.